Inflation refers to the rise in prices of goods and services, leading to a reduction in the purchasing power of consumers if their income does not keep up with it. Investors may choose to transfer their funds to assets that are more likely to benefit from inflation or at least keep pace with its rate. Persistent deflation, on the other hand, can lead to a rise in unemployment and may negatively impact the financial system and the broader economy by making debt servicing more challenging. The U.S. Federal Reserve aims to maintain a 2% average inflation rate over time, which it considers to be most in line with its dual mandate of promoting price stability and maximum employment. Significant deviations from a moderate inflation rate can present challenges for both investors and consumers, as they have the potential to cause significant economic disruption and may have varying and often unpredictable effects on different asset classes. In the field of economics, inflation is measured quantitatively by monitoring the rate of change in prices of a standardized basket of goods. It is characterized by an increase in prices over time, with the rate of this increase being expressed as a percentage. Welcome to Money Mindset, where we provide educational resources on money, personal finance, and investing. In this video, you will learn how to be in line with inflation. If you're serious about enhancing your financial future, make sure to hit the subscribe button and like this video if it was helpful to you. How the inflation is measured. To monitor inflation, several economic reports are commonly used, including the Consumer Price Index, CPI, the Producer Price Index, PPI, and the Personal Consumption Expenditures Price Index, PCE. The PCE price index is the preferred inflation gauge of the Federal Reserve as it is a broader measure than the CPI and is weighted based on consumption measures used to derive the gross domestic product. The CPI measures the weighted average of prices paid by urban consumers for a standardized market basket of goods and services and is reported monthly by the Bureau of Labor Statistics, BLS. The PPI, also reported monthly by the BLS, is a weighted average of prices realized by domestic producers and includes prices from the first commercial transaction for many products and some services. The PCE price index, released monthly by the Bureau of Economic Analysis of the U.S. Department of Commerce, is a broader measure than the CPI and tracks the change in the price of goods and services purchased by consumers. All three indices provide a core reading excluding the more volatile food and energy prices. Another alternative measure of inflation is the trimmed mean PCE price index, which is calculated by the Federal Reserve Bank of Dallas and excludes spending categories with the most extreme price moves in either direction. How inflation affects asset values. When it comes to the effects of inflation on the economy and asset values, there are some general guidelines based on history and economics. One of the most significant impacts of inflation is on the value of fixed-rate debt securities, as it reduces the value of both interest rate payments and principal repayments. Lenders may lose money if the inflation rate exceeds the interest rate. To address this, investors often focus on the real interest rate, which is derived by subtracting the inflation rate from the nominal interest rate. Longer-term fixed-rate debt is more susceptible to inflation than short-term debt because inflation has a more substantial effect on the value of future repayments, which compounds over time. Assets that are expected to bring in more cash or increase in value as inflation increases tend to perform best. For instance, a rental property that can periodically increase rent or an energy pipeline that charges rates tied to inflation. Real estate. Real estate is a favored investment during times of inflation as it tends to hold its value and generate rental income. Investors can choose to purchase real estate directly or invest in it through specialized funds or real estate investment trusts, REITs. Historically, real estate has performed well during periods of persistent inflation, such as in the 1970s. However, it is important to note that real estate investments can be negatively impacted by rising interest rates and financial crises, as evidenced during the 2007 to 2008 recession. In response to high inflation, conventional monetary policy involves increasing interest rates, which can also have an effect on real estate investments. Commodities. Investors often seek tangible assets that are likely to appreciate in value when inflation increases. Gold has been a popular choice for centuries as a hedge against inflation, with its price rising alongside inflation. Gold can be purchased directly from bullion or coin dealers, or indirectly through mutual funds or exchange-traded funds, ETFs, that hold gold. Investors can also invest in commodity producers directly or indirectly through ETFs or specialized mutual funds. Commodities encompass raw materials and agricultural products such as oil, copper, cotton, soybeans, and orange juice. Commodity prices typically increase along with the prices of finished products made from those commodities during inflationary periods. For example, higher crude oil prices result in an increase in the price of gasoline and transportation. Sophisticated investors can trade commodities futures or shares of producers. However, exchange-traded funds that invest in commodity futures tend to underperform the price of a rising commodity because their futures positions must be rolled as they expire. Bonds. Although investing in fixed-rate debt may seem counterintuitive in times of inflation, inflation-indexed bonds provide a variable interest rate that is tied to the inflation rate. In the United States, Treasury inflation-protected securities, TIPS, are a popular option and are pegged to the Consumer Price Index. With inflation-indexed bonds, such as TIPS, the value of the investment increases when the CPI rises. In addition, the amount of interest payments paid is based on the increased base value. Other inflation-indexed bonds are available, including those issued by other countries. There are various ways to invest in inflation-indexed bonds. TIPS can be purchased directly through the U.S. Treasury or a brokerage account. They are also available in some mutual funds and exchange-traded funds. For a more aggressive investment, consider junk bonds, which tend to increase in value during inflation as investors seek the higher returns offered by this riskier fixed-income investment. Stocks. When it comes to keeping pace with inflation, stocks have a reasonable chance of doing so, but it is important to note that not all equities are created equal in this regard. High dividend-paying stocks may not perform well during inflationary times, much like fixed-rate bonds. Instead, investors should consider stocks of companies that can pass on their increasing input costs to customers. One such sector that may be a good option is consumer staples. Loans or debt obligations. Leveraged loans can potentially serve as a hedge against inflation. They have a floating rate feature, which allows lenders to increase the interest rate to match the inflation rate, thereby maintaining the return on investment. Another option is to invest in mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which are pools of mortgages and consumer loans structured into securities. Although investors do not directly own the underlying loans, they invest in securities backed by these loans. However, MBS, CDOs, and leveraged loans are complex and carry some level of risk, depending on their rating. They often require a sizable minimum investment, making them less accessible for most retail investors. As such, a more practical option for retail investors is to invest in a mutual fund or ETF that specializes in these income-generating products. Pros and cons. Investing for inflation has its advantages and disadvantages, much like any investment strategy. The assets described above also have their own set of strengths and weaknesses. One major benefit of investing for inflation is the ability to maintain the value of your portfolio. Additionally, it can help ensure that your nest egg continues to grow. Diversification is also an important consideration when investing, especially for inflation-fighting strategies, as it can help mitigate risk and maintain a balanced portfolio. On the other hand, investing for inflation can also increase exposure to risk, potentially divert from long-term goals, and lead to overweighting certain asset classes. It's important to weigh the pros and cons carefully and consult with a financial advisor to determine the best course of action for your individual situation. However, it's important to keep in mind that while investing for inflation can be beneficial, it should not take priority over your overall investment plan. If you have specific goals and timelines for your portfolio, it's essential not to deviate from them. For instance, if your investment plan requires significant capital appreciation, it's not wise to overweight your portfolio with TIPS. Similarly, if you need retirement income soon, buying long-term growth stocks may not be the best option. It's crucial to avoid being too focused on inflation and making decisions that take you out of your comfort zone regarding risk tolerance. There are no guarantees in investing, and traditional inflation hedges may not always work. Unique economic conditions may result in unexpected assets performing well, while previously safe investments may lag behind.